Welcome to the video on financial derivative. Please, this is going to be a very extremely short and a sweet video. I request the audience of this video to watch it, re-watch it. In fact, there might be certain terms which you don't understand. You may Google it or refer back with your during the classes altogether. Financial derivatives, I'm just giving you an introduction. Remember, derivative is an instrument whose value depends on the value of the more basic underlying variables. And that is what we need to understand. It's a derived value from certain other instrument. It's instrument, but it is deriving value from certain other variables altogether. That's what we are looking into. More specifically, a derivative is a contract about buying, perhaps also of selling a specific asset or portfolio for a specific price K at a time where T is less than or more than T as of today's and the present rate, where T is the duration of the contract that we go around it. Today's time, next expiry time. The assets can contain stock, currencies, products, etc. So you name it. It is not product, it is actually commodities. Let's say oil have been traded, uh, gold has been traded. These are your things. Various minerals have been traded. So the asset, so as of today's time and in some time in bigger future, right? And that is what we are calling as a duration altogether. So that is what derivative is. Remember, derivative is derived from the underlying assets altogether. Ways derivatives are used to ensure changes or risk as hedge to get high profit in certain market conditions. Why high profit? Because when you're trading in a derived derived derivatives, what is happening is you are utilizing less of a capital. So it is all about speculations. To get a quick low risk profit arbitrage, as the case might be, to change the nature of investment without the cost of selling one's portfolio or buying another. As in, it's a derived product, you are not going the base product altogether, which is from it is derived from. So you might be looking at their call option, their put option, their expiry, the future prices, and so on and so forth. So that is what we are trying to address. Remember, to ensure against change or risk, to get high profit in certain market condition as a speculator, to get a quick low risk profit. Why? Because you're not putting the whole capital which the instrument would be asking or demanding. You're just getting in dealing with a derivative, and to change the nature of investment without the cost of selling portfolio or buying another. Next is all about forward contract. A forward contract is an agreement between two individual companies to buy or to sell an asset at a certain time t in the future for a certain price k. This is future trading from today's for 7 days week time or a 1 month week time or 6 months or 1 year week time. That's the future prices that you are predicting and probably you are trading right now. Why? Because in future you might be making much more profit depending upon your prediction, the delivery prices. That's what is future contract. That is what is forward contract. What is future contract? Similar to forward contract, except that it is traded only on exchange and can be bought and sold by third parties, but before the end of the contract, and it has a legal validity that needs to be gone for. So yes, we have a forward contract and we have a future contract. Both are future contract, but in future contract it is done in a exchange under strict stipulation regulation, and it has to be squared off at the end of the contract. So swaps, giving an examples of derivative, a swap is an agreement to exchange cash flow at a specific future times according to a certain specific rules. Options, we have a call option. When the prices are supposed to go up, you are purchasing call option. When the prices are supposed to go down, this is all your predictions. Remember, it is whether it goes down or goes up is completely different scenario altogether. So when prices goes down, you should be dealing in puts or put option. You should be buying the put option. So options, contract holders chooses when he buys the asset and exercise the contract to for a price K at time T or not. Put option, a contract holder chooses whether he sells the assets when the prices are going down for the price K at time or not. A European option can be exercised only on the expiration date. An American option can be exercised at any time on up to the expiration dates. As in, if let's say Saturday is an expiration date, usually stock markets are closed on Saturdays, but just giving you for example, in European option, you will have to close all your contract or square off all your contracts only on Saturday. But in European, could have you could have entered a contract, you could have exited the contract on Monday, Tuesday, Wednesday, Thursday, as on when on your wish. Examples of forward contract, let's say on January 3rd, 1990, a trader with a long position with a view that things are going to go high enters into an agreement to buy 1 million in 3 months at an exchange rate of 1.6196. This obligates the trader to pay 1,619,600 dollars. That's the key. That's the amount for 1 million. So that's a pretty profit of 619,000 $19,600. So if the exchange rates rose to 1.65, that is a 1,650,000, the payoff is 1,650,000 minus 1,656,196,000. So that means the trader has made a loss of approximately 30,400. That's the loss that we are going around it. But in case if the price would not have risen till much, or in case the price would have been more or less stable out there at $1 itself, at $1.10 or $1.15, would have made a whopping profit thereby. So yes, the long and short position. Remember, in a long position, we are talking about the call buyers. If the prices are going up, the profit goes up. If the short position, if the prices goes down, the profit goes up. Now this is what we are talking about it. As in the short position, a short position is where we are talking. See, as long as it is not going to the strike prices, you are making profit. The moment it exceeds the strike profits, you get losses. Similarly, for sellers position, what happens? As long as you are not going your strike prices, you are making a profit. The more profit increases, but with the moment it crosses your profit position, you're making losses, and that should be kept in mind. So example of call option: a trader option holder buys a European call option. Remember, European call option only expires on the expiry date with 1,000 shares of decode with a strike price of $14 and an expiration date of 1 year. The option price is approximately 50 cents, so the holder pays $500 for the contract. If the decode share rises to $17, remember the option holder has a margin of $2.5 per share and makes a profit, straight away profit. Why? Because the strike price was at $14 and it has increased to $17. So there is what we are talking about, $2,500 is what he is going around it. Remember, the strike price is $17, which has exceeded what he had predicted. It would be predicted more than $14 or something like that. So an increase of $3 minus the $500 which he has paid, he make a simple 5 times the profit of his investment. How is the 5 times? Because the investment was only $500. What is his total takeaway? It is $2,500. So the share prices rise to 14.2. The option still exercises the contract. Instead of losing $500, he only loses the differences. That is approximately $300. In general, a call option is exercised if you are looking at a strike price which is going to increase over a period of time. Long call option profit from buying a decode European call option. Let's say option price is approximately 50 cents, strike price is $14, option life is 12 months. Now this is where you are actually making a target. We are purchasing this target. We are purchasing this point, $14 point, saying that this within 1 year this target should be breached. So that's my call option. But right now I'm making a loss. I'm betting out here when I'm sitting on a $11 prices. But over a period of time of 12 months, we see that there is a change in the price and the price goes to approximately $17 till this dollar. So what is happening? My profit goes around it. I was $500 less, which was my investment, but the moment it crossed $14, $14.50, I start making a profit with the investment of $5, and the terminal stock prices reaches to another $2,500, and for which is the profit of my cases. In this case, I need to wait for the whole 1 year. Recent example of derivatives, future funds, let's say Framwell, about this has been stated. I'm just giving you what has been stated in February 15, 23, built from 7 types of future contract currency stocks. Decode options again is the call options and put option, call option when the prices is of the underlying asset is going to go high. You purchase a call option when you think the prices of the underlying asset is going to go down. You're purchasing the put option. So expiration date is call and put options are $5, $7.50, $10. Expiration dates in March, April, July, October. Option pricing depends on the price per share and the duration that you are willing to take risk. So market interest, return on investment. Let R be the market interest for 1 year. That's a return without risk, absolute return that your federal government is giving to you. If the return from the stock is lower than the R, then we choose a course to put our money in a risk-free return. If the interest rates are calculated continuously, T is the time of maturity, and then the risk-free return is all about future pricing. This is what your future pricing with the strike prices of the time, the expiry date time, and the return that we need to go around it. Considering basic return as R, which is no gain over the risk-free return, then we do not place the money. Its value is going to decrease to something which is absolutely doesn't make sense because it becomes negative altogether. So value of forward contracts, let R be the risk-free interest. F0, the forward price of a contract. K is the delivery price. The value F of the contract with time to maturity is T. Is F, remember F is your value. So F0 is your future prices minus the delivery prices that you are talking about it in times the return that has been expected over a period of time. At general, when T is 0 or less than 0, then the small t is the price that you're willing to pay for it, which is again less than the big T, the time duration, which the future prices that you're going to go around it. So an example is a 6 month long forward contract. Risk-free interest is 10%. The forward price is $25. The delivery price is $24. So what do we go around here? Do we make changes? Definitely yes, because delivery price is $25. Forward price is 25. Forward price is $25. Delivery price is 25. Now what are we making? We are making of forward the contract for $2.50 or less than $2.17. So does it make sense altogether? Probably yes. This is what my forward pricing. This is how I'll be making a profit. With this, I come to an end of this video. Thank you for watching it.